Good morning, everybody. And it's great to see everybody on day two. We had a great discussion yesterday as part of the emerging managers panel, where we had three hedge fund managers talk about different strategies. And today we're going to get the chance to continue that with Olga, who's sitting there in front of the room. So hello, Olga. It's a pleasure to see you. We also have David Rhudy. David, can you give a little shout out from where you are?
Morning.
You're in New Orleans today?
Yes, sir.
Excellent. Peter Habib, how are you today? I know you spoke a little bit earlier.
Yeah, so I replaced, that's my uncle. So I'm stepping in for him. My name is Peter Powers. I'm a second generation member of MPI Family Office. So I run on real estate platforms.
Gotcha. Terrific. So this is going to be our panel today. I'm looking forward to this discussion. Alternative strategies are always interesting to me, especially consider they're alternative strategies to alternative investments, right?
Yeah.
So it's always a little bit different. My name is Mark Heil. I'm part of institutional sales for Pacific Premier Trust. We do a lot in the area of self-directed IRAs, fund custody, and things along those lines. Being part of a bank, I have to do a disclosure, so I'm going to get that out of the way very quickly right now. And that is Pacific Premier Trust performs the duties of an independent custodian of assets for self-directed individual and business retirement accounts, and does not provide investment advice, sell investments, or offer any tax or legal advice. Clients or potential clients are advised to perform their own due diligence in choosing any investment opportunity, as well as selecting any professional to assist them with an investment opportunity. Alternative investments are not FDIC insured and subject to risk, including that the loss of principal. Pacific Premier Trust is not affiliated with any financial professional, investment sponsor, or investment or tax or legal advisor. So there, my lawyers are very happy. My compliance department is overjoyed, and we can move on to the important stuff here. What I'd like to know is we gave a very quick intro of everybody up front there, but let's just take a little bit and dive in a little bit deeper here. David, I'm going to start with you. David Rhudy is a partner with Protocol Capital, a placement agent who's raised $3 billion since 2012. David, you want to put a little color on that? Tell us your background and tell us what you're looking to get out of today.
Yeah, David Rhudy here, Protocol Capital. As you said, the firm been in existence since late 2012. Have placed close to $3 billion since that time. We're fairly agnostic as to strategy, but more interested in finding talented people that are doing smart things and that have shown an ability to make money over multiple market cycles. So we're always on the lookout for talent. As our business evolves, we're placing our own money. We're also advising, different investors, and then also searching out investors for the managers with which we contract. My background, been on the street for a long time, started in 1984, got into the alternatives game starting in 2003, and have been in the alternative space since. What I'm looking to get out of this is just, meet interesting people and, kind of share to the audience what we do and the efforts that we have.
Fantastic. So I would encourage all our panelists to type in their contact information into the chat room and to keep your eye on that as you're speaking, because people may have questions for you directly. They can directly communicate with you through that. Olga, obviously it's a little difficult for you being there to be doing that, but what I'd probably like to do is now have Olga speak for a couple minutes, tell us about your background, your quant fund. Olga, just so you know, is the managing director of Synthesis, which is a quantitative hedge fund using big data and AI to inform its decisions, maybe machine learning anyway. How about that?
Yes, thanks for the introduction. Yes, so at Synthesis, we run a statistical arbitrage equity strategy, market neutral, and we one of the few investment management teams who've been actually successful in using machine learning and big data in our investment strategy. Beside that, we're also interested in investing our own principal, friends and family money into interesting financial technology companies and perhaps emerging quants, but unfortunately, there's not too many opportunities, like good opportunities that we see. That's one of my goals today is to like meet investors who probably have a good deal flow on that one. On my background before Synthesis, I was a head of data strategy for Constellation. It's a multi-horizon quantitative firm trading on various markets, high-frequency trading to mid-frequency strategies. Before that, I worked on a sell side also with quantitative managers, and before that, I was raising capital for a discretionary hedge fund. So I've been in the alternative investment business almost my entire career, and I'm super excited to have this conversation today because like a year ago, that would be alternative investments was a much harder sell. It was really much harder to make a case for alternative investments when everything was at the market. The S&P was just going up. But today it's especially important to go back to thinking about alternative investments, alternative strategies as a diversification instrument in the portfolio of a family office or an institutional investor.
Great. Hey, Olga, I'm going to ask you to do us a favor and use a mic. Yeah, that'll help. I could hear you just fine, but I know there was some noise in the room that made it hard for people to hear you.
Is this better? Yeah, I think it's better.
I guess it's louder in the room. I don't know that it's louder over here, but
Yeah,
we'll take care.
that was a noise of some sort.
Yeah, there's a mic in front. Is that plugged into the internet, Marty?
Yeah, I'll be just using the mic.
Okay. So, well, that was a terrific introduction. Now I want to go over to Peter Powers, even though he's showing off as Peter Habib here, and he runs the real estate, I guess, group for MPI Holdings Group, a family office consortium. So tell us a little about the consortium. Tell us about what you do at the real estate group, and how people here can take advantage of that, and what you're looking to get out today.
Yeah. Well, I appreciate the introduction, Mark. So again, my name's Peter Powers. I run the real estate platforms for my family, which is MPI Holding Group or MPI Family Office. I think a good way to understand MPI is to kind of take a few steps backwards, understand our history. So about 25 years ago, my father and uncle started building diabetic care facilities across the west coast of Florida. Built that up into a great brand. From there, they decided to start taking some of that money and pivot and to get involved into some other assets. So, to go another step back, they grew up in a family. My grandfather was a CPA, had a big accounting firm out of Pittsburgh. So we're very tax efficient in terms of how we look at things. So one of the strategies that's worked very well for us is pairing operational businesses with the tax efficiencies of real estate. Now going to the real estate side of it, we're in apartments, we're in self-storage, we're in senior housing. We have about $1 billion and a quarter of real estate, bunch of apartments, bunch of self-storage, bunch of senior housing. We're deciding to pivot a little bit and to put more of our capital and time towards affordable housing. That's not just it's a huge benefit to families and individuals across the country. But it's a pretty lucrative business. We have two different platforms that we've been carrying out, one of them being a low-income housing tax credit platform, which are essentially rent-restricted apartment communities. We've been looking to build that platform in the Southeast as well as in the Mid-Atlantic. And we've also been making a lot of progress purchasing existing hotels across the country and converting those to apartments. So we've acquired probably about $300 million of those just in the last year, and we have another $150 million under contract right now. So we see those as solutions to the growing affordability crisis. In terms of the consortium, about 7 years ago, we started opening up our family office to other family offices, other ultra high net worth families and entrepreneurs with fast growing businesses that were, again, building wealth fast or had tremendous amounts of wealth, but just didn't know what they didn't know. So we kind of opened our doors in terms of our advisors that were in-house, as well as some of our advisors that we outsource to. So that's what we call our consortium.
So the consortium's purpose then
Yeah.
is really to provide advice to the families. So these are loosely connected families. Do they sometimes come together investing in your projects, or is that
Yeah.
completely separate from what you do with with the
No,
group?
no. So we've opened it up. So I mean, again, sharing strategies, so tax strategies, wealth strategies that can, anywhere from tax planning for their businesses to wealth strategies, like asset protection type strategies that for their next generation. But we also share our deal flow. So
Okay.
on typical deals, we're putting in $5 to $10 million of equity, and maybe a portion of that we'll carve out for a family. Because some of these families, they just don't have the deal flow. They're still involved in the first generational business, and they don't have the time to build up a family office and to build up this deal flow. So we'll share it with them, and again, help them understand and take advantage of the tax efficiencies of real estate with their operating businesses, just as we did.
Great, great. Well, I want to sort of really get this discussion going here. And David, I remember in our prep call, you had said something that caught my attention. You said you're looking for smart people doing smart things. I guess with alternative strategies, you're looking for smart people doing, different smart things, if you would. But in your opinion, how would you define an alternative strategy? You're on mute, by the way, David, so you have to unmute.
Sorry about that. Today is a great day to talk about this with the market coming a bit unhinged again. Really alternative strategies in my mind are, those strategies not necessarily correlated to, the broader investable universe, i.e., S&P 500, the stocks, the European stocks market, and those. So, the different things that we look at, or people have approached us with, we've gotten very large over the years in litigation finance. Litigation finance is an area that is obviously uncorrelated to anything in anyone's portfolio. It's a more mature investment strategy in Europe, particularly the UK, and it's an emerging strategy here in the States. The returns for us to date have been, outsized. I don't believe the risk is anything too great, depending upon the manager that you select and you align yourself with. But that's kind of an example of something that we would look at. Since I've been on the street for many years, I did work with the Schoenfeld group, Stephen Schoenfeld. So I had some time on the systematic side, the high frequency trading side. That's another interesting area that tends to be non-correlated. So we see a lot of different things. We're being approached all the time. I will say, to date we've done nothing in crypto or in cannabis so far.
They took away two of my questions now. I'm just
well,
kidding.
I'm giving you a preference on what we look at and what we do. But so
I want to just
go
pick
ahead.
up on something. I particularly want to go back to the litigation financing. One of the things I always think about alternative strategies is that there's a whole bunch of education that has to take place. Obviously it's a new arena, it's an emerging strategy. So I want you to talk to me about what it took for you to get some interest in that among the people you were showing it to. Who did it appeal to? I mean, there's people that obviously are more prone to buy these alternative strategies. So maybe you could speak from that angle. And I thought, why did you think it would work here?
Great question. I think that there has been some education involved with investors. Really, people ask us all the time, is there a channel that we work? Are you all family offices? Are you all pension consultants? Are you all, registered investment advisors? Really, it's kind of all of the above. And within each sector, there are groups that tend to look at more eclectic strategies. the investors that we've had, as far as, litigation finance in specific, have been family offices, for sure. We're starting to see, the large consulting firms, look at this space because they're getting requests of information for it. But, we also, talk to, some of the larger, alternative asset management firms. So, the big banks are involved. So it's really, starting to position itself as a strategy, as an asset class that has been kind of, approved by the, investing universe.
Sure. Peter, I want to come over to you a little bit here, and specifically, I want to just think about, if in order for one of these strategies to be successful, an alternative strategy to be successful, it needs a buyer. It needs somebody who believes in it, wants to own it, wants to build it. So talk to me a little bit about, particularly, as you made shifts and you're doing things differently, what it has been like for you to get people in your group, or do the ideas come from them? Hey, we should be looking over there. Talk to me a little bit of how it works with you.
Yeah. So essentially what drove that decision is we've been involved, we'll stick with the housing, the multifamily. We've been involved in that business for about 8 years. And we've seen, rental prices on workforce and affordable housing go up 50%. So it's really squeezing people. So when you have, rents going up that much and incomes just aren't keeping pace with that, it's affordability crisis. It's getting worse and worse. So, a couple of years ago, we decided to pivot and to figure out where can we, build or buy where, we could still be able to provide affordable workforce rents. And the answer was we just couldn't. We couldn't build because the cost of build was just too high, and you can't buy pre-existing products. So we got very creative. We saw some of these hotels were trading at much lower prices, and if we were to convert them to an apartment community with a higher multiple, then there's an opportunity there. But kind of what the big hurdle for us was you're going to have set 300, 400, 500 square foot units. They're small, but how we kind of got around that is you have giant amounts of common area space that you can convert to amenities. So you might have smaller units, but you're still going to have the nice co-working, you're still going to have the nice gyms, you're going to still have the storage, and these are very well located. So once we do that, we kind of eliminate the lease up risk there. And in terms of an end buyer for this, I mean, you could still get the agency financing. It's a little bit trickier, but when you have agency financing, that's a huge incentive for multifamily. It keeps it more liquid than all the other real estate asset classes because it's there, and we need housing, and housing needs to be provided for families and investors. That debt source is there. So we're still having very good success selling these to our end buyers, but ultimately we'd love to hold on to them long term.
Got it. Olga, you're sort of in the same position where you have this, machine learning, data-driven technology that you're using to really help make your fund successful. So talk to me what it was like to get it, to convince investors that this was something good, that it was something feasible, that you could do it and execute on it. What was that like for you?
That's a really good question. And I would like to get back to your earlier question, as in what is an alternative strategy? So alternative strategy, apart from being uncorrelated and seeking risk-adjusted positive returns regardless of the market movements, I think another thing about alternative strategies is that they highly specialized. In other words, there are like people who know sort of real estate strategies or litigation finance or quant, like nobody's business, and that's why investors hire them. And that's why alternative strategies cost much more than just exposure to ETFs or just plain vanilla equities. But a lot of times investors, what they're trying to do is they're trying to really understand the strategy to the extent they can replicate it. And it's always been a problem with quants. I mean, I once met an investor at a conference and he had a PhD. And he told me, well, we invest in different kind of strategies, but you don't invest in quants. And I said, why? And he said, because it's really difficult to understand. So I guess my point is, in order to really take advantage of quantitative strategies or data-driven strategies or anything that is highly technological, investors don't need to understand it to the extent they can replicate it, because if they could, why pay 2 and 20 or whatever they pay to those asset managers? That's the first thing. Another thing is, like, we all use iPhones and we do like pretty significant things with that, but I don't think any of us know how to assemble one. And I think what's important to like really take advantage of those strategies is to ask the right questions. And it's hard to do, but it's an investor's job. And I think like for family offices who maybe don't have internal capabilities to have like all the researchers and come up with all the right questions on the due diligence side, maybe it makes sense to co-invest or find like a independent advisor for that. Because the questions that you ask, like a hedge fund who runs a machine learning strategy, will be very different from the questions you will ask a discretionary hedge fund manager who invests in a long-short equity, or private equity manager, or venture capital, or real estate.
Well, talk about that. What were the questions and how were they different?
Well, for example, questions when it comes to machine learning, there should be a lot of questions regarding data, because like, you know, garbage in, garbage out. It's not really the algorithm that makes it, you know, unique and can work with any data. You can't really control that algorithm because it's machine learning, it's a black box by design. But you can definitely ask certain questions and understand what kind of data that hedge fund manager uses, or where they take it from, how they make sure the data are high quality. What kind of a process they have in place, what they do if something goes wrong, right? What they do if there's an alpha decay in certain signals, like what they do if their data vendor goes out of business. So things of that nature. Like obviously risk management will be different, diversification of their portfolio. So yeah, so that's, but on the other hand, you probably wouldn't ask them like where their offices are, or do they have like printed trade confirmations, because obviously they don't.
I was going to say, so, and I don't want to take up too much in this. I want to come back to this obviously throughout the morning, but I guess the question I have is, you know, how do they get convinced that the data you're feeding is the quality data? How do they get convinced that the decisions that your algorithm is going to make is going to benefit them and is going to adjust to the market in time? How did you get them comfortable with all that? And
well, yeah, like I said, for data quality, there are certain issues that are like worth discussing depending on the data type. Like outliers, like missing values, like the consistency of the historical data. I don't want to get into like too many technical details, but the thing is, if you use machine learning, you absolutely need a consistent historical sample. And you absolutely need to explain what kind of data and how do you use the data to have enough of it to run in sample and out of sample testing. So those things are very important. And then for another thing is the AI has been such a hype that I know some investors think like, oh, AI is such a great investment opportunity. They hear AI, they want to invest with a hedge fund. There are other investors who say like AI doesn't work and it's just a marketing hype, which I think it is. But so when you talk about machine learning, it's important to understand what part of the process machine learning is involved in. I mean, like, for example, I don't tell people that we have some machine that trades the markets and it's better than a human being. No, we use machine learning in our research process. It just makes the research process more efficient and cheaper because we trade 3,000 names. There's no way you can hire that many people to analyze data on 3,000 names, right? So it's just the tool of increasing efficiency. But it's not only that. I mean, there's still a quantitative analysis component of it. So machine learning is not everything, right? That algorithm is not everything.
Got it. So David, you're a placement agent. You've just heard Olga speak about machine learning and AI. You've got investors that you interact with regularly. Give me your reactions to it and your thought process around what would your investors, not so much on the merits of her firm or anything like that, but the types of questions your investors would have for Olga. You're on mute again, so.
Sorry, I'm trying to be
That's all right.
here. No, it's interesting you ask, but currently we have a mandate with a manager out of Zurich, Switzerland, that is a quantitative manager that has done quite well over the years, and since our inception in my history, I probably worked with 3 or 4 systematic managers, particularly in the volatility space. So we do have a roster of investors that are interested in the space. I think one thing with systematic managers, one thing they always ask is, do you have a lean to your portfolio? They also want to know, how you win and how you lose, and so that they can have an understanding. Like in a day like today, what are you doing? If you've marketed yourself as someone that's going to be totally non-correlated to the market, and you're a winner in days like today, you better win. But they're going to ask questions such as that. The number of factors that you use, when putting together your strategies, and some of the people that we talk to are pretty dialed in the space, and really want to dig in. I find a lot of quant managers get very protective very quickly, and sometimes I don't know if that's the best strategy when talking to investors. So those are just a couple things, and I'll turn it over to you, Olga. All you.
Terrific. I'm going to shift this over to. Go on.
Can I briefly comment on that? Well, the first thing that I respectfully disagree with is that quant managers or any kind of hedge fund managers are supposed to beat the market all the time. It's not that. Like, you can expect a hedge fund manager, like highly specialized, to beat the market when it's up 30% and be up when the market is down 30%. Another thing that's important to understand, that the nature of the quantitative strategies is that they take advantage of those temporary inefficiencies in the market that are created by the actions of other market participants. So in the days like today, the days like in March 2020, like obviously the correlations and those temporary inefficiencies, like they change, and it's important to be self-aware, if you will, for a quantitative manager. So for example, some days it makes sense to just stop trading for a while. So I think that the bigger problem is that all the good quants out there, they don't really like accept, they're not open for external capital because the strategies are not scalable enough if they really like make money, or they just asset gatherers are not that great of a uncorrelated alpha generating ones, as they say.
Yeah. And I think that was sort of David's point, was that if you're saying you're non-correlated to the market is down today, then you'd expect, if you just even stood still, that you look good by relative comparison to the market. Peter, I want to shift over to you and talk to you about real estate and using data for real estate, and how that informs you what you're doing differently to educate your investors and to make decisions. Are you using more data today than you use, or is it just the basics that are driving your decisions?
Yes, I mean, we're definitely using data. So it's nice that we have a pretty good footprint of about 6,000 apartments, bunch of self-storage, bunch of senior housing. We can rely on those numbers to help us keep a pulse on the different markets. It gives us an advantage, which I don't think there's any better advantage than when you go into a market you're already in and you can pull real numbers, instead of some of the numbers that you might, we subscribe to, in our world's, the Rhudy matrix and a couple other subscription models, which is great, but I never trust any numbers unless they're, I can really see them as concrete numbers. And for us, that would be the properties we own. So I can look at those and be like, okay, this is where stuff is trending, especially with cost right now. Insurance is going crazy, taxes, payroll. It gives me a real idea and a really good competitive advantage, because when we do go to buy it, we have, we can come in with, this is our best price, this is what it's going to be. And I think a lot of sellers look at that as, okay, they're honorable, they already own in this area. This isn't someone that's going to retrade us and try to bring down the cost. But on that end of it, it's been great. We've started implementing some more technology. So you're seeing these crazy rent increases across the country. So on our non-rent restricted, just conventional apartments, we've implemented technology where it's looking at the market, it's looking at every lease that's open in the market, every unit that's open, and it just constantly adjusts your rates. So, if a resident might come in, or a potential resident might see the unit, might be $1,000 today, tomorrow it could be $1,200. So it's always fluctuating. So we're utilizing the daily pricing, and on a lot of our, just on the conventional side, our renewals, instead of going up 5-6%, some of them are going up 10-15%. So a lot higher than we would have expected. And a large part of that is due to the technology, which can read the market instantaneously and then spit out a number.
Well, that's interesting that you're using it to sort of reprice it on an annual basis. Obviously, inflation is kicking in there and being part of that.
Yeah.
And I guess that's sort of, at a time that we're in right now, we have a lot of geopolitical instability. We have, inflation, we have interest rates, supply chain issues going on. And, I guess, you sort of touched on it here, Peter. And maybe you just want to elaborate a little bit more about how you track this and how this enters in your decision making when you're selecting the site, or when you're deciding to open up another property or acquire a hotel.
Yeah. So I guess we could use right now, it's on everyone's minds, there's, the war out, with Ukraine and Russia. So when you look at some of these markets, they've changed a lot, over the last, decade or so, but you obviously don't want to own in areas where there's a huge military presence. If we just decide to send out a bunch of troops, that could really affect your properties. There's it written in every single lease. If you're in the military, if you're active duty and you have to get deployed, your lease is automatically not. It's just, they can cut off the lease, which is understandable. They're getting deployed. But if you own the property and you have a high concentration of that, or you're in an area that has a high concentration of that could really adversely affect your property. So we keep an eye on that, and we want to go into areas that have diverse employment centers. So that's big for us. But in terms of inflation, you're noticing it everywhere, and we came out with something. We came out with something this morning, kind of speaking towards this, because even in St. Petersburg, Florida, they're looking at potentially implementing rent control. And some of the issues that kind of happen, putting rent control into place. You see it in areas like Oregon and New York City. It can really have some adverse effects. Especially as landlords, we own properties, expenses are going up. We want to keep these properties affordable. We want to keep them clean. We want to keep them safe. But if we can't increase our income side, and our expenses keep increasing, that means we're just to, again, make ends meet. We're going to have to start trying to decrease expenses where we can. So maybe we start, we have to fire one of the members on the staff. Maybe we don't, start putting in some of the security material, whatever it might be. So the property might still be affordable, but you might start, the property might not be as safe. It may not be as clean, because maybe you're having less people work on the property. So, we look at things like that. That could be a potential risk. And, we weigh them. We speak with the city to kind of understand, what they're looking at and how they're assessing it, and, kind of try to get an idea of what decisions that they'll make. But that's definitely something that's on our minds right now is, if they start implementing rent control, we're in so many different areas that could really, really affect us.
Sure. David, I want to flip over to you. And you know, same type of question, you know, this changing world economy that we're in right now, how is that affecting investors' view of the world? What are they doing, particularly family offices? This is a family office discussion here. You know, what are they doing in reaction to this, and how's that affecting their decisions about where they want to invest?
Well, you know, going through this a number of times over the years, you know, I find they tend to get very quiet in periods like this as they're monitoring their, you know, their current portfolio. Some of the more venturesome, you know, maybe looking to you know, other strategies, other asset classes. But when we're in these periods of upheaval, things tend to quiet down. Capital flows slow, if not end, for a period of time, as you know, they try and determine, you know, next steps. But you know, really right now, you know, people are laser focused on, you know, their current book of business, you know, wanting to understand, you know, what's going on, you know, how those managers are performing. But at the end of the day, you know, volatility like this creates opportunity, no matter what you're doing, what asset class you're in. I would sure, you know, real estate, you know, will, you know, be interesting. You know, the markets are obviously interesting, but you know, it makes for opportunity, and you know, these periods are, you know, when you can really, in my experience, you can really, you know, put some money to work and be paid for that risk that you're assuming now.
Are there areas they're avoiding?
Well, I think, you know, one thing that happened for sure was, you know, there was a big move to kind of long bias, long only, because of this, you know, historic run that we had in the equity markets. And it seems like, you know, without a doubt, that's come to an end. You know, volatility, you know, is back in the markets, should help, you know, real equity long short managers, be they discretionary or systematic. You know, I think, you know, hedge funds in general, you know, should do good, you know, in periods like this when there is a great deal of uncertainty, if in fact, you know, those managers are talented as they say that they are.
And I want to flip over to Olga here. And Olga, let's talk about how investors can benefit from data insights, particularly when you have a turbulent market.
Well, first of all, I would like to say that there's kind of a false perception that big data and alternative data and everything that's available right now, people think it's only like for quants, for mathematicians, for data analysts. But in fact, if you think about it, this data that is available to us now at such a great extent, it is even more valuable for private investors, for venture capital investors. Specifically in industries that are new, you don't have really too many comparables that are publicly traded. You don't have like the SEC reporting, like you don't really have that information that you have for public markets. And that's exactly where you can gain those insights from alternative data. And I think that's one of the reasons why a lot of hedge funds, people who've historically been focusing on public markets, they're now actually looking into private markets, and they're prioritizing them so much that they even like compete with the biggest private equity investors, with the biggest venture capital investors, and they obviously have the capital to compete, and arguably they work with data much better. That's one way to benefit from the abundance of data. I think another thing that is going on right now is data vendors and companies that work with data and create products and maybe even sell side. They kind of learned how to create those products to make it available to someone who doesn't have 10 PhDs in their team. So I personally think that in the nearest future, we will see much more like actively managed ETFs or other access products that would include that data component and more complex factors, not just traditional factors, but factors actually from alternative data and from big data available now.
Great.
Mark, I have a question here for
sure.
for Olga. So you're talking about alternative data. There are so many tool sets now to extract data and information about companies. Can you kind of describe like how people do this? I mean, a great example is like you can kind of scan every article on the internet and then go for keywords and find, you know, specific references, you know, using Python or something like that. I mean, it's amazing. Another example is that we had somebody who claimed that they had cornered the Los Angeles real estate market because they had drones looking at IKEA and tracking the most traffic, what neighborhood it was going to prove people move, you know, new people moving into gentrifying neighborhoods. So, I mean, there's all kinds of data out there. Can you describe it in a little more detail, Olga?
Well, yeah, absolutely. Well, this example with satellite tracking number of cars and parking lots to estimate sales and brick and mortar stores, it's like one of the most kind of popular idea of alternative data, but there's so many different data sources, and not all that data sources are actually relevant to a certain investment strategy. So, for example, the satellites, they're probably not very helpful to firms like ours because they only cover maybe like 3-5 companies. Like the data it's not actually big data, right? Now, for example, like web scraping or textual data, natural language processing, which is actually a legit AI algorithm. That's exactly where AI actually works, and machine learning actually helps. So it's not like artificial intelligence is trading the market or making investment decisions, but what it definitely can do is it can work with textual data to extract it and to digitize it and turn it into a machine readable format. And unlike market prices, textual data is actually big data. It's like a lot of data, right? And the way you work with it, like for example, 2 data vendors or 2 different hedge funds, they can use that same data source, for example, like scrape data, or they use SEC filings or like any available data out there. But the way they process it, the way they work with it, is going to yield a very different result. So that's another source of competitive edge.
I guess one of my questions is there's so much data coming at people, such as, you know, coming at you, coming at Peter, coming at David. You know, how do you use that efficiently to make decisions, whatever the decision is, whether it's a buy, sell, or whether it's to locate a property here, or, you know, how do you make sure you can get that down to usable data and not be overloaded with just information?
Well, first of all, we need to start with you know, self-awareness, like what kind of inefficiency in the market we're exploring, because it's not like a random person just sits there and thinks, how do I use alternative data? It's there's a fund or there's an investor who's been doing it for years and they have a certain approach. So that's say we are a quant investor, we have an approach kind of like in a width rather than depth. And there is another investor who has a concentrated portfolio. They are discretionary long short. They know there are 10 companies like nobody's business. They're going to be using that data very differently, right? They will be using that data to assess a competitive landscape for a certain company they're working on. They will put together that mosaic of information, and they will use this tiny bit of data in conjunction with everything they know, like all the sell side, with IR of that company. That's one approach. What we do is a totally different approach. Like we don't really care about fundamentals of the company. We care about having as much data as possible, quality data, and then we use our machine learning algorithms. So like to answer your question, first of all, the data has to be relevant. You have to understand what is that you're trying to achieve. And then you use the data, because alternative data is no different than all the fundamental approaches that we've been using for years to trade the market. It's just a different format, and it mostly requires hiring an internal team or an external advisor to actually create a product out of that data, to like clean it and make it usable. But other than that, it's just an information.
Gotcha. So Peter, talk to me a little bit about where you are today and what you see. You know, you mentioned you just pivoted, started buying hotels. But if you were to think maybe 3-4 years down the line, what are the alternative strategies you think might be after that? Go on.
So I think we'll still continue to buy these hotels. We're looking into manufactured housing now. So homes that are built in essentially factories that are, brought out to the sites. A little bit of the issue there is it's not as easy to get, or you can't really get conventional financing. So if you were looking to sell this to a first-time home buyer, yeah, it's cheaper, but they can't get the 30-year first-time home buyer type of package. So I think that's going to come around. We have our two different tax teams right now looking at what potentially will happen with this infrastructure bill that's coming out. We think there's going to be some huge incentives towards affordable housing, just given the need for it. Maybe that comes in the way of, and you saw this a couple of years ago with apartments, Fannie Mae and Freddie Mac, the government sponsored enterprises. They came out and they gave pricing waivers on the interest rates if you went in and you fixed the windows and made them more energy efficient, and you put in better toilets where there's not as much water. You did things like that, and they were giving like 20, 30, or 40 basis point waivers. So you'd save a good chunk of money doing that. And they would loan 100% of whatever the cost would be to do that. So we think that might come in. Right now they're already they already have a mandate that 50% of all the funds that they give out or finance has to be to product that has an affordability component to it. So, we're keeping our eyes and ears perked for that. But I think we're going to keep going forward and, again, keep doing what we're doing. But, I'm sure we'll pivot to maybe instead of just rentals, we'll get into something where it's affordable and we can, sell it to families where they can build equity and hopefully utilize that equity to, again, leverage it to maybe into their business or to something else.
Hey, Mark, I've got a question here, and it's for David. So, we've covered litigation finance in a lot of different ways in our group. There's, litigation finance, there's litigation settlements, there's all kinds of different aspects. And, where you are litigating matters, what countries you're litigating against matters, like where the company is located that you're litigating against, who's the jury matters. Can you talk, David, a little bit about, what you see in the litigation finance space? And I mean, there's actually companies that specialize in massive lawsuits, and then companies that specialize in a bunch of small lawsuits. So, David, can you give some kind of, draw us a picture of what you see happening?
Yeah. Where we're involved is, more corporate to corporate type litigation. Like you said, there's a lot of different, you can buy settlements. We don't really think that's litigation finance. That's more structured finance itself. Definitely there are opportunities in, the mass litigation. That's not an area that we involve ourselves with, more corporate to corporate. Another area that's gotten really big, especially in the UK and in Europe, is a law firm financing, where you might have a group of attorneys that are exiting a magic circle, firm is what they call it in the UK, top 100 type firms, where you've got 5 or 10 guys that are looking to exit with a book of business. We've done some financing there, over the years. But the litigation that we're financing is more corporate. The sweet spot maybe from a finance standpoint is, say, $5 to $20 million. The largest thing that we've ever done is a $50 million piece a couple years ago. But we operate solely in jurisdictions where English law is in force. So, a number of the Western European countries, obviously the UK, Australia, as well, has been an area that, you're seeing a fair amount of litigation finance being done there. And then, things are definitely growing here in the States, leaps and bounds. The team that we represent we have one ex-litigator who really understands, talented, attorneys, around the country. And then the other partner is a structured finance guy out of one of the, big, Wall Street banks for a number of years. So we kind of played both sides there.
David, can you kind of give a picture into like the process for litigation finance, like how the companies that you work with, pick their targets, and how much actually these things go to litigation and go to trial, and what gets settled, et cetera?
Well, for corporate litigation, what we focus on, or what our teams focus on, 90+% of that litigation is settled, prior to, going to court. When you go to jury, things become very binary. You're a winner or you're a loser. And usually, in the cases that our guys are going to be involved with, the sums of money are pretty significant, and neither party, really wants to take that risk, if you will. Another thing that we see, the litigation that we'll buy into, many times, when we lose early on a motion to dismiss. And, we're hopeful for, settlement. I know, one of the big pieces of litigation that we financed here recently, the $50 million piece, settled, 3 days before, going to jury. So, those things, tend to happen, but the vast.
What's the disparity between, I know this is all an expected values game. So like when you settle, what kind of expectation of IRR do you expect versus, the IRR on going to trial?
Well, we underwrite for a 30%, gross IRR per annum per opportunity. We also underwrite to a success rate of 65% on the cases that we undertake. I will say that we've been fortunate to date since inception with this group that they've been winning at a 90% rate, and their IRR right now per annum gross is over 50%. Litigation finance is a little bit different. It's kind of like private equity, in that, there's a utilization rate, getting money out. You may have a $10 million case, but you only have financed it to $2 million, and then it settles. You may have a case, you get a $10 million case, you've got $500,000 in it, and it is dismissed, early in the proceedings. So, a lot of different things can happen. Utilization rate on, absolute commitments can run between 65, to 80%. But I think, the investors that we work with understand that and make accommodations for that.
What percent of cases that you pursue end up in a loss?
Right now, as I said, they've been running at a very high rate. So, they're better than 85% successful. So, and losses have come early. I think we had one case go to the jury, and it was a complete loss. But their success rates are very, very high.
Is having one go to jury and losing, is that just a failure in selection? And do you have,
I think
optionality to reject a bad case?
Say that again?
Do you have optionality to reject a bad case?
Oh yeah, I mean, if we see 100 cases, at the end of the day, we might only pick, 2 or 3 of those cases to invest in. So there's, constantly, people are coming to us and being rejected, or coming to the team and being rejected. So that's not, that happens all the time. But, once you're involved in a case, you're committed to that case. Now you can have different options that allow you to exit if the law firm does something not improper.
Yep, gotcha.
I think we have an extra commentator there. David, thank you for.
Minutes, guys.
Yeah, I was just going to say, we're going to do a quick wrap up here, Marty. Obviously a great job by our panel. I think we've learned a lot about machine learning, litigation, finance today, and the real estate markets and where they're evolving to. And I really think alternative strategies is more of an evolution of the markets and the more sophistication of them. So what I'd like to do is maybe have each person just, take a minute and sort of give the one thought they'd like to leave the audience with. And Olga, I'm going to start with you since you're sitting there in New York.
What was the question again?
Question was just one final thought on the day for what you want people to remember about what you do
Yeah, spend a minute on what people should be thinking about as they walk away from this.
I think the important thing about alternative strategies in general is that it's identifying the trend or identifying the market opportunity and then finding people who are like really good at it, who are experts, and then choosing the right structure depending on what you're looking for, what kind of investor are you, and that's I guess that's the key to approaching alternative strategies, and definitely diversification, like not trying to make the alternative strategy everything for everyone.
fantastic. Peter, why don't you take a minute here and just sort of give your summary on your thoughts and what people should be taking away from what you discussed today.
Yeah. So we look at things. I appreciate everyone, going into depth of what they do, and it is unique. And what goes through my mind is how do you underwrite a lot of that? Again, we're very conservative with how we model things, and it's worked out very well for us. With all these, with the inflation and with all these things happening inside and outside of our country, I think my family's blessed to be in the business that we're in, that we got hit pretty good during COVID, the onset of COVID, and we did a great job surviving that. So, it definitely gives us more confidence into the groups we work with, the projects we invest in. So knowing, down the road that, what we did was, it's been, kind of battle tested. So it's very important that if you are investing alongside, other managers or investing with other partners, to definitely, look at their track record and make sure that they've had those bruises, they've had those battle wounds, and really understand what they've gotten from that. Because at the end of the day, you could be making a bunch of money in the stock market or any other investment for a number of years, but it just takes one bad year, one bad opportunity that just really derails your business. So we're very, very, we're cognizant of that potential risk, and that's why we've passed up on a lot of deals over the last couple of years.
Terrific. David, you're going to get the final word here.
Appreciate it. No, I just think, exciting times, with our business, we've prided ourselves in kind of, constantly looking for unique, talented managers in whatever, strategy they may have. And we'll continue to do that, do our due diligence. I think, as Peter said, due diligence and understanding track record is very, very important. And we do that, and, we'll continue to do so, and, look forward to what this year will bring and many years to come.